$850 billion is not just a number on a balance sheet. It is a loaded weapon aimed directly at the heart of the American housing market, and the finger on the trigger belongs to the People's Bank of China. For the first time in history, the threat of a massive treasury dump has stopped being a conspiracy theory and become a mathematical certainty. We are witnessing, in real time, a geopolitical divorce that is forcing a fundamental repricing of nearly every financial asset. The 30-year fixed-income instrument that underpins the U.S. housing market is about to detach from economic reality and surge, regardless of what the Federal Reserve does. If you thought 7% mortgage rates were painful, you are not prepared for what happens when the largest foreign creditor simply walks away from the project. Before we explain exactly how this works, how this liquidation destroys purchasing power, and how to position defensively, make sure you are subscribed to the channel to follow this silent financial war on a daily basis. And comment below whether you trust gold or the dollar more. To understand the magnitude of this threat, we need to examine a detail most analysts ignore. The widely cited figure for China's U.S. Treasury holdings is around $760 billion, but when you add U.S. agency debt such as Fannie Mae and Freddie Mac, China's total exposure rises to nearly $850 billion. This is the true financial nuclear button Beijing holds over the U.S. economy today. For 2 decades, this relationship was symbiotic. China sold cheap goods, the United States consumed them and paid with dollars, issued as treasury bonds. Those dollars were recycled back into the U.S. debt market, keeping interest rates artificially low and China's currency competitive. It was the largest financial transaction in modern history, directly subsidizing the American consumer's standard of living. But the trade war broke this cycle. Aggressive tariffs turned a strategic partner into an economic adversary. When the United States signaled that Chinese dollars were no longer welcome, China responded by stopping the recycling of those dollars into U.S. debt and began liquidating its existing positions. The latest TIC data confirms that China is selling U.S. assets at the fastest pace since 2015. This is not a random market fluctuation. It is a state-level strategic decision to de-dollarize its economy. The bonds being sold are being converted into physical gold acquired by the ton. The People's Bank of China has added gold to its reserves for more than 2 consecutive years, a historic streak. They are exchanging paper promises from a hostile government for an asset with no counterparty risk. The warning came in 2022 when Russia's reserves were frozen. Beijing got the message. The real problem, however, is not what China is buying. It is who is not buying the bonds China is selling. The U.S. government runs annual deficits measured in trillions of dollars, requiring constant debt issuance just to keep the system functioning. For years, China absorbed a massive share of that issuance without hesitation. Today, it is not only absent from auctions, it is actively dumping old bonds into the secondary market. This creates a brutal oversupply. And when supply exceeds demand, bond prices fall. In fixed-income markets, that means one thing: yields surge. That is exactly why 10-year Treasury yields are rising even as inflation appears to cool. The market has realized there is no longer a sufficient marginal buyer to absorb the tsunami of U.S. debt. The Federal Reserve is engaged in quantitative tightening, selling bonds instead of buying them. U.S. banks are already overloaded with government debt and sitting on massive unrealized losses. Japan is struggling to defend its own currency and has also become a net seller of treasuries. This leaves the domestic American investor as the final pillar financing government spending. To persuade that investor to buy long-term bonds, the government must offer increasingly higher interest rates. This effect ripples across the entire yield curve, impacting every loan in the economy. The most direct impact hits the 30-year fixed mortgage, which tracks the 10-year Treasury yield. If Chinese selling pushes the 10-year yield to 6%, mortgage rates mathematically rise to around 9%. We are witnessing a complete decoupling of mortgage rates from the Fed funds rate. The Fed could cut rates tomorrow, but if China sells $50 billion in treasuries, mortgage rates still go up. This completely neutralizes the Federal Reserve's ability to stimulate the economy or rescue the housing market. We have entered a regime of fiscal dominance where debt supply matters more than monetary policy. Beijing understands exactly how much pain this inflicts on the American middle class. Housing is the primary engine of the U.S. economy and the main source of household wealth. Keeping interest rates high is a way to engineer a recession without firing a single shot. This offensive aligns perfectly with the escalation of technology sanctions. It is direct retaliation. You cut off our semiconductors, we cut off your cheap credit. The difference is that China can survive for years without cutting-edge chips. The U.S. economy cannot survive years of 9% mortgage rates without severe collapse. Commercial real estate is already on the brink of insolvency, and another spike in rates would be the final blow. Trillions of dollars in property value can be erased simply by a shift in bond yields. The U.S. Treasury has no way to stop this without forcing the Fed to restart the money printer. But if the Fed monetizes the debt China is selling, inflation explodes again. That would mean monetizing the debt of a foreign adversary and destroying the dollar in the process. This is the perfect trap, except deflationary depression or inflationary collapse. There is no soft landing when the largest creditor pulls the plug. China also uses custodians in Belgium and Luxembourg to mask the true scale of its selling, meaning official figures likely understate the real pressure. Every rally in the bond market becomes an opportunity to unload more exposure. This places a permanent ceiling on bond prices and a structural floor under interest rates. The era of 3%, 4%, or even 5% mortgages is over, possibly for an entire generation. The dollar's exorbitant privilege is being eroded transaction by transaction. If the world no longer wants to hold U.S. debt, America must pay an ever higher premium to finance its lifestyle. That premium is paid by you every month through higher credit card rates, higher auto loans, and higher mortgages. It is geopolitical risk embedded directly into your cost of living. We are watching 40 years of globalization unwind in just a few years. The bond vigilantes are back, but this time they are state actors with strategic agendas. They are not selling because they fear inflation. They are selling to inflict pain. And that pain is now seeping into the real economy as refinancing costs crush companies, banks, and consumers. The stock market is betting the Fed will save the day. The bond market knows that may be impossible. Debt supply has become a mathematical impossibility to absorb. We are witnessing a slow-motion crash in the plumbing of the global financial system. The old liquidity backstop has been exhausted. The next shock will have no margin of safety. This is not a warning about the future. It is happening now. Cheap credit is gone, foreign buyers are gone, the bill has arrived. The choice is simple and brutal. Hold paper that loses value or own real assets that survive monetary collapse. China has already made its choice.